Welcome to Public Legal Information. We would like to share a webinar presented by John Stapleton that covers what to think about when you retire with low income. Thank you, John, for this information.
Okay, thanks very much. It's a pleasure to be here this afternoon, and I'm really grateful that so many people decided to join in. I'm looking at the bottom of my screen right here, and I see that I have 79 slides. So I am really going to motor through this. I think someone will be looking at the chat as we're going through in terms of gathering questions and maybe some clarifying questions. So I don't mind if the hosts, Reggie, if you wish, you can stop me if there's something that really needs to be, like if there's a burning question. But let's try to leave the Q&A to the end of the presentation. I could also advise you to go to my website, which is called www.openpolicyoontario.com. So that's all one word, Open Policy Ontario. And there's a tab called Retiring on a Low Income. And in that tab, one of the first things there is a booklet. And that is the booklet that when we were in pre-COVID times, we actually handed out that booklet at the library sessions I've done going back to 2012. So let's get on with it here. I think there might be some people that haven't. Is everybody got their mute button on? So as we so we don't get too much noise as we go through. Thanks very much. So what's new in 2020? So what is baked in? What do we know is going to happen? What has happened with COVID-19 and the various reactions there, and what is new? Okay, so first of all, what we were supposed to have was a higher old age security payment for people who are 75 plus. That was actually in the mandate letter for the Honorable Minister Deb Schulte, who is as the Minister of Seniors, but in the throne speech, they re-announced it, but my question is, when is that going to come in? And so we haven't seen that come in, so I'm following the papers every day to see when the new increment. So that would be like another $65-70 a month for people who are over 75, so that would be quite welcome. There is quarterly indexation in old age security and GIS, but that quarterly indexation doesn't always happen because inflation has to meet a threshold before they'll increase it. So on October 1st, 2020, so just a month ago, we got almost $1 more in old age security and almost $1 more in guaranteed income supplement, but that was the first increases in a year. Now with COVID-19, we of course have had the CRB, the Canada Emergency Response Benefit, and the Canada Recovery Benefit, and so there is some bad news for working seniors who receive the guaranteed income supplement, and that is that the CRB and the Canada Recovery Benefit will not, in fact, be treated as earnings. It will be clawed back from the first dollar. And so anybody who, say, got $2,000 a month in CRB, then they're going to see at least $1,000 a month clawback in that. So the federal government, interestingly enough, told provinces and territories to exempt the money from the CRB, but it's one of those things that sometimes a bad parent will say, do as I say, not as I do. And they clawed back the benefit that they told other levels of government not to claw back. Another important thing is because of COVID, they brought in reduced RRIF. Now, our Rrif is a registered retirement income fund. I'll be talking a bit more about Rrifs later on, but the Rrif withdrawals after age 71 have been reduced from 5.28% down to 3.96% per year, and then they will go up to as much as 20% beforehand, and now they're only going to go up to 15% in terms of the Rrif amounts that one must take out of their Rrif accounts once they reach 71. As you may know, that all RRSPs, it's like the story of Cinderella. The chariot turns into a pumpkin, and all RRSPs turn into Rrifs at age 71. That happens to all of us, 100% of us. And
now I want you to do something.
at that point, the Rrif, at that point, then you have to take money out of your registered retirement income fund. Now, for the time of COVID, and I think they've already gone back now, is that Gains A was doubled from $83 a month to $166. Now, Gains A is a special payment that the province pays through the Guaranteed Income Supplement. You don't have to apply for it. In fact, you can't apply for it, but it only goes to people whose income, now wait for this, whose income is less than $2,000 a year. So very, very, very low income seniors get gains, and they get it. It goes straight into their bank account along with their Guaranteed Income Supplement, and you can't apply for it. It comes along with it to very, very low income seniors. For example, seniors who haven't worked at all during their lifetime. Now, there was a one-time COVID-19 payment, the GST credit. There was a special GST credit. And for people who received old age security, OAS, they got a special payment, non-taxable, of $300, which they all should have gotten by now. In the Guaranteed Income Supplement, or the GIS, there was a special payment of $200. And there was also a payment, a disability payment of $600 for people who either get the disability tax credit, this DTC, or if they get Canada Pension Plan disability, or whether they get Veterans Disability, they would get $600. But anybody who got the OAS credit of $300 or the GIS credit of $200, somebody who got both of those would only get a $100 disability payment. The maximum amount that you can get from the total amount is $600, and that could be made up of $300 in OAS and $300 in disability, or it could be $300 in OAS, $200 in GIS, and $100 in the. So the maximum amount that they will pay is $600. They won't pay. So the OAS and the GIS credit is offset against the disability payment if you, in fact, you're eligible for the disability payment. So that's really what's new for 2020, all on one slide. And there wasn't any real changes announced in the throne speech except to re-announce what you already see right here. And so, of course, afterwards, these slides will be available to you, and so you don't have to be madly scribbling all of this down right now. So let's, what I'm going to go through today is what you need to know. First of all, I'm going to talk a little bit about residency in Canada. I'm going to talk about what seniors get in Ontario, and I'm going to be very, very specific about what I mean by low income. Then I'm going to talk about taxable income, because taxable income and how our taxes work is very, very important to the receipt of income for both old age security and for the Guaranteed Income Supplement. So they are very integral. So anybody who is going to get these incomes from old age security and GIS, and especially low income people, must file their taxes. Okay, you must file your taxes. I know that's very difficult these days, but even if you were to get a tax return, answer a few of the questions and not even fill the whole thing out and just send it in, then at least that you have filed. So don't worry about getting everything right. And we know that the volunteer programs are not working in the various seniors programs right now. So that's really important that you do figure out a way to file, whether it's through adult children, whether it's through older people, whether it's through friends or neighbors. Make sure you file. I'm going to talk about how to reduce your taxable income or get money back, how to understand the system. And then once we have got a low income retirement and we're maximizing our benefits, how do we protect it? How do we keep it from being eroded? Then I'm going to ask and answer the question, why didn't I get this advice from the bank? And the main answer there is the banks don't make money off low-income people, and they don't make it their business to know anything about low-income benefits. They're not social service agencies, they're corporations out to make money. And then finally, how do we spread the word? And I'll say a little bit about that. So let's get going, and let's talk about residency in Canada. One of the things that a lot of people get wrong is, especially if they are moving to Canada as an immigrant or a returning Canadian, the rules are the same for residency for both immigrants and refugees and returning Canadians, okay? And it's based, your eligibility for old age security and GIS is based on your residency, your legal residency in Canada. It's not at all based on your citizenship. So what does the federal government look at? They look at 40 of the 47 years between your age 18 and 65, breathing Canadian air legally. In other words, you are here as a permanent resident. You're not, it does not take into account your citizenship. And if you're here on a visa, like a super visa or something like that, where you really have visitor status, it does not count towards your residency in Canada. It's only your permanent residency that counts towards the residency here. So it's any 40 of the 47 years between 18 and 65 will get you full old age security. You have to get 40 years. So for example, if you have 10 years in Canada, you're going to get 1/4 of your old age security. If you have 20 years in Canada, you're going to get 20/40ths of your old age security, or 1/2 of your old age security. And then just to complicate things further, we have 59 agreements of other countries with Canada, where 1 year in Canada gets you the equivalent. You can apply for old age security, whereas other people have to wait full 10 years before they get old age security. Now, I'm not going to read out all the countries. Where you could get countries is go on my website at openpolicyoontario.com and go under the retirement on a low income tab, and that booklet, the booklet that is there called that's low income retirements, right up at the top of that page. On page 35 of that booklet, it lists the countries. Or you can also go online, old age security, and say and ask the list of countries that have social security agreements with Canada. There are 59 countries, and it's a very idiosyncratic list. I can tell you the only country in South Asia or Southeast Asia is the Philippines that has an agreement with Canada, and the only African country is Morocco. Many of the Caribbean countries have agreements with Canada, and a number of South American countries do, the United States, Britain, and many countries in Europe, but only one country in Africa, Morocco, and only one country in Asia, which is the Philippines, that have these agreements. China and India do have some agreements with Canada, but they don't get you the 1 year where you can get, for example, come here at age 64 and then get 1/40th of your old age security at 65. Only the Philippines in Southeast Asia is the only country that has that type of agreement with Canada. So for people, so it's not all bad news if you only get a little bit of old age security because you've come here late in life, or you're a returning Canadian who came back to get healthcare in Canada, or because one thing that I didn't know is that there are a number of countries across the world that that have early retirement. And so what we're seeing a lot of Canadians that of various sorts are working across the world who have to retire at age 62 or 63, and then they come back and they want to still work in Canada. So we have those situations. So there is a super GIS, so an extra income tested benefit for people with less than 40 years of residency. And once again, that booklet that's at at my website, openpolicyoontario.com, under the retirement on a low income tab. That booklet tells you all the amounts of money that you can get in extra GIS when you're only getting a little bit of the basic old age security. So for example, if you take a person, I can tell you that my own brother spent most of his adult life outside of Canada, and he comes back to Canada with only 11 years in Canada that qualify him from his 18th birthday, and he just turned 65, and so he would be able to get 29/40 of the super GIS. So it's a complicated formula. I don't recommend that anybody try to actually work out that formula. For those who have less than 40 years in Canada and who will get less old age security, they need to go to the website or call Service Canada, telling them the country that they came from to see if it is on the list of countries with an agreement, and then go from there in terms of the amount of guaranteed income supplement that they may get. Now, some more interesting news here is that sponsorship, people who are under an active sponsorship are not eligible for the guaranteed income supplement, period. Sponsorships are now for 20 years. And so it may mean that someone who comes in at the age of 63 as a sponsored immigrant would not be able to get their GIS until they're 83. Now that was an announcement made by the Harper government back in 2014. And so the first people who would test that in terms of it being more than a 10-year sponsorship won't come up until 2024, right? So if the policy was made in 2014, the first people who will be coming up having a sponsorship longer than 10 years, that will be in 2024. I can tell you, we still have some people that should be muted online here, where a lot of noise is coming in on the program. So if people can mute, that's going to be a lot better. So sponsorships are now for 20 years, but it's still not clear. So if you want to advocate with your MP and say to your member of parliament that with your sponsorships that are going to the 20-year point, that it makes sure that you would be able to get the guaranteed income supplement after 10 years, that policy just has not been made yet. I should also point out that super visa residents, people who come over on super visas where they have to return to their home country after a couple of years, are not eligible. They are not building up their years in Canada because they are considered to be visitors. So it's only permanent residents, people who are breathing Canadian air legally as permanent residents, who are eligible to start building up their years in Canada towards their 40 years of eligibility for old age security. So there are telephone numbers to call Service Canada, and if you want to call about your Social Security agreement, first of all, to find out whether your country has a Social Security agreement with Canada. And in Canada and the United States, the toll-free number is 1-800-454-8731. And for someone who is outside of Canada, they can call collect. Outside Canada and the United States, they would call the number 1-613-957-1954. and their hours of operation are 8:30 to 4:30 p.m. And they do have experts on particular countries, and so it's really going to be important in terms of that in terms of those countries, that you, if you come from a particular country that has a Social Security agreement, they will have an expert there who's able to talk to you about your residency in various countries. Now, I can tell you that when I do this presentation, I always get somebody who will put their hand up and say, I spent a number of years in a country that did have an agreement, and then I spent a number of years in a country that didn't have an agreement, and now I've come to Canada. How much will I get? My answer is I have no idea. Is because it's you really do have to look at what your eligibility is, and that is a unique individual case basis for people who have been in various countries before they come to Canada, some which have agreements with Canada and others that don't. You'll also notice a URL at the bottom of this particular slide, and when you get these slides, you can click on it, and it also takes you to those various different Social Security agreements. So now we're past residency in Canada, and now we're going to talk about what seniors get in Ontario. All right, so in no particular order, what seniors get in Ontario starts with Canada Pension Plan. And basically, if you paid into the Canada Pension Plan, if you pay into the Canada Pension Plan, you will you can start out with an amount of, I'm just moving my slides here. If you paid in, you can get a pension, a maximum benefit at age 60 of $752.53. Sounds like a lot of money. And age 65, you can get $1,175.83 a month. But you only get that kind of money if you worked all your life. If you worked for 40 years and you paid in at the maximum of CPP, then these are the maximum amounts you can get. Most people have not worked the number of years to get the maximum benefit, and most people will not have paid in at the maximum amount to get the CPP. So you will know that when you work, there's various different deductions that you get off your pay slip, and one of them is EI, another one is income tax, and another one is the Canada Pension Plan. So you can look on that and you can see the amounts of money that are being taken off. And if you work and you're making over about $55,000 a year, then you're going to get the maximum taken off every paycheck. And if you work for 40 years, then you're going to be eligible for these amounts. One thing I'm going to be telling you throughout this presentation is that if you're low income and you're not receiving social assistance, that's Ontario Works or ODSP, then you should be applying for CPP at age 60. Why? Because the amount is lesser, which means that your GIS clawback once you reach 65 will be lower. We're trying to avoid clawbacks. And so if we take early CPP, the amount of money we get is less. We get it for another 5 years, but your clawback will be lower. And you can't live long enough to on the other side of it to maximize that benefit. You'd have to live well into your over age 100 before you would be better off than taking it at age 60. Now that's usually goes against the advice that most people are giving. Often they're saying wait till age 65, wait until you're 70 before you take your CPP. If you're low income and you're going to be getting the GIS, no, take it at age 60 unless you're on social assistance, ODSP or OW, which means you shouldn't take it because they will deduct it at 100%. So take it at 60 if you can, and if you're not on social assistance. Old age security. Most people 65 plus get this. There are also some benefits for low-income spouses, not yet 65, called the spouse's allowance. But right now, The new benefit as of October 1, 2020, the old age security per month is $614.14. Now that amount is taxable, and some people decide to have their taxes taken off at source. So if you get your old age security in your bank account and it's less than $614.14 and you've been here for 40 years, then the reason it's less is because you are paying some tax on it at source, which a number of people choose to do. But if you're low income, you can decide not to have tax taken off it by calling CRA, and then you can have the full $614.14 per month put in. But people who have not been here for 40 years will, of course, get less than $614.14. If you've only been here for 20 years, then you're going to get $307.07. You know, it works on based on 40 years as a denominator, and however many years you've been in Canada after the age of 18 is your numerator. That's another way to put it. Okay, so the next big program is the Guaranteed Income Supplement, and that's mainly what we're talking about here today, and how to maximize your GIS. People with low incomes may get the GIS, and right now the maximum payment, non-taxable, remember CPP and OAS are both taxable, but the non-taxable amount is $917.25 per month. Hardly anybody gets this maximum amount. Why? Because most people will have some sort of income coming in, even if it's only a low amount of CPP. But I do meet into people who did not work any amount in their lives because of disability or for other reasons. Some people have been homemakers or caregivers and have not received money as pay, and therefore they can be eligible for the full amount at age 65. But the problem is with GIS is there's a clawback, and the clawback starts at 50%. So even if you only have a few dollars, you're going to get less than the $917.25 per month because of this 50% clawback or taxback rate or reduction rate, whatever you want to call it, on the Guaranteed Income Supplement. So then there is, as I just said earlier, there's this extra other small amount called the Guaranteed Annual Income System, or GAINS, that's in Ontario only. And again, you don't apply for it. You get it through the Guaranteed Income Supplement that you did apply for, and it's only if you have less than $2,000 in income per year. So it's only for very, very, very low income seniors. And during the pandemic, the amount of gains, which was $83 a month, they doubled it to $166, but I think that's now over with. It's not part of the recovery benefit. And I also have in brackets there $1,500 in RC, which I mean by that of refundable credits. So there's various different credits that seniors get along with others. We get the carbon credit is a refundable credit. The GST credit is a refundable credit, and your Trillium benefit is a refundable credit. And those refundable credits add up to about $1,500 a year for low-income seniors. So the next form of income that seniors get is income from savings, money you put into an RRSP or a tax-free savings account. RRSP stands for Registered Retirement Savings Plan. Tfsa is a tax-free savings account. And then another form of income people get is a private pension, which would be a pension from where you worked. And then others, of course, more and more seniors are earning now. Freedom 55 went out the door some years ago, and so people are now getting income from earnings, money that they work for wages or honorariums. And how do they know? Well, you get a T4 if you have earnings, and you get a T4A if you're getting money but you haven't been, it's not considered earnings. So you should, that's why you always look at your T-slips to see which ones they are, and you can tell whether in fact that you've been working within the meaning of the tax meaning of earning money. So let's move on from there. And now we're getting into what does low income mean? And I got some very specific ideas on that, because what we're going to talk about low income is people who receive the GIS. Now in Canada, 31% of all seniors who get old age security also get the guaranteed income supplement. So it's over 3 in 10 seniors get the guaranteed income supplement. So it's really important. So what are we looking at here? For a single person, anybody with income below $18,624, not counting old age security. So that $18,624 could come from bank interest, it could come from a pension, it could come from dividends or other gains that you make. It could come from your CPP. It could come from any one of a number of sources, as long as it's income and the amount of income that you have over 65 is less than $18,624, not counting your old age security, then you will be eligible for the guaranteed income supplement. So that number, 18,624, is sometimes called a threshold or a break even. That's the people who have $18,625 in outside income will get no GIS. Somebody who has just under 18,624 will get a little bit of GIS, and someone who has no income at all will get the full $917 in GIS. So it's like a sliding scale, but the sliding scale starts at 18,624 and under. And like I say, that's not counting OAS. If you want to count OAS in, then it's 25,457. It's under that amount. So for couples, if they're both getting the old age security, in other words, they're both over 65, and their combined income is less than 24,576, then they will be eligible for at least some GIS. If it's just below 24,576, then they're going to get a little bit of GIS. If they have no income, they'll get the whole amount. And if their income is above 24,576, then they will get no GIS. Now, for a couple where only one partner is getting OAS and the other partner is under age 65, for example, a 66-year-old woman with a 21-year-old husband, that would be a situation like that. I'm just making a joke. And but that situation, you have an income of 44,640 or less, then you will get some GIS. And if you have over that together, then you will get no GIS. And then finally, if you have a couple, one partner is getting old age security because they're over 65, and the other partner is age 60 to 64 and getting the spouse's allowance, which they now just call the allowance, then below that amount, you get GIS. Above that amount, you get no GIS. If you have no income at all, you will get the full GIS. So those are the thresholds. So I'm saying people who are low income are people whose income are below those amounts, not counting their old age security. And the reason we don't count our old age security is that old age security does not count towards GIS. Old age security is something that you get, and your GIS is on top of that. So we have to look at incomes other than old age security are the amounts that are going to reduce your GIS. Old age security itself does not reduce your GIS. So let's move along and talk about the clawback, the tax back on the guaranteed income supplement. The tax back on the guaranteed income supplement is 50%. So that means if you have $2 in income, your GIS clawback is $1. If you have $1,000 in income, then your GIS clawback is $500. If you have $10,000, then your GIS clawback is $5,000 in that year. And then just to complicate things even further, there is also a supplement to the supplement. So the GIS also has a supplement that's paid on top of that. And unfortunately, it causes a further clawback only on the income between $4,600 a month, $4,600 a year and $8,400 a year. The income in that range is clawed back at 75%. Now, why is that important? It's going to be important when we start to talk about work, because if you're working and you're getting 75 cents on the dollar clawed back, maybe you'd want to think about working. And so I'm going to talk about that a little later. So 50% of what sort of income is the clawback? Well, if you take money out of an RRSP, then you're going to lose 50 cents on the dollar to the GIS clawback. If you have a pension, you're going to lose 50 cents on the dollar to the GIS clawback. If you receive CPP, then it's going to, if you have $10,000 in CPP in a year, then your GIS clawback, you're going to get $5,000 less in GIS at least. If you have investment income, it's going to be clawed back. If wage earnings, but wage earnings, there's an earnings exemption. For those people who are familiar with social assistance, they know that there's an earnings exemptions in social assistance. Well, GIS also has an earnings exemption. And as of 2020, this year, that wage earnings is $5,000 that's exempt. And then the highest recovery on that is 50 cents. I'm gonna come back to this. And then finally, money from honorariums, money that might have come out of a cash box, money that comes out of, that's paid to you for helping out with something like at a church or a nonprofit. Money paid in honorariums is also clawed back at 50 cents on the dollar. And we're gonna talk about that and also how to avoid it. And remember, income from old age security does not affect the amount of GIS that you receive. There's no clawback on the guaranteed income supplement itself. So let's move on. Now, for those of you who have watched all the programs that you want to on Netflix, and you're looking for something to do on Saturday night, and you're thinking maybe I'm going to sit and figure out those extra clawbacks on the guaranteed income supplement, I put in a chart here so that for those of you who are mathematically inclined and graphically inclined, you can see where the recovery or the clawback rate is actually greater on GIS, and it shows that it's between 4,600 and 8,400 in private income. The GIS is an average rate of 75%, but it can be as high as 92%. But I just leave this graph in here for people who are mathematically and graphically inclined and would like to look at that. So this was done back down in 2016, and the amounts are slightly different, but I can tell you that the policy and the math within the graph still remains accurate to today. So in 2020, good news, the earnings exemption on GIS, so the amount you can earn before there's any clawback, went from $3,500 in 2019 up to $5,000 in 2020. And before, it was not extended to the self-employed. If you're self-employed, you didn't get an earnings exemption, but it's now extended to the self-employed. And the tax-back clawback rate, the extra clawback on the GIS supplement, the supplement to the supplement, is not there for people who are earning. So the most amount that they will ever get clawed back is 50 cents on the dollar, $50 on $100, $500 on $1,000. And if you make $10,000, you get $5,000. So that is the clawback amount. So let's move on for earners, and we're going to come back to earners. So now there's a test. And as everybody knows, a test or an examination is defined as a happy recollection of work well done. So all the work that you've done over the past 45 minutes, now that you'll be able to apply it in this test. And this is Tina's story. Tina is a single mother who received social assistance from age 18 to 30, and then she went back to school. She worked as a part-time nurse's assistant from age 30 to 50, and she became disabled with multiple sclerosis and received ODSP, and now she's turning 65. What is Tina going to get? Well, Tina has going to get Canada Pension Plan of $364. But when we look over at the right side, we see the maximum payout is $1175.83 per month. Why is Tina getting less? Well, Tina is getting less for two reasons. Tina's getting less because she only worked 20 years from 30 to 50. So she didn't work, so she's automatically going to only be able to get about half of her CPP, but then she didn't pay the full amount. So the maximum amount she could pay into CPP, she wasn't paying that amount because her earnings were lower. So you can see that she's going to get less than half of her CPP for that period of time. Now, her old age security is $614.14, and the maximum payout is $614.14. Why? Because Tina spent at least 40 years of the 47 years between her 18th and 65th birthday in Canada, so she gets the full amount. Now, I'm going to go down one from here and say her guaranteed annual income system, her gains amount, is zero. Why? Because Tina's income is over $2,000 per year. And if she gets, so she'll get no gains payment at all, because even the $364 that she gets in CPP would take her over $2,000 per year. It would take her to over $4,000 a year right there. But she also has income from savings of $10 a month, and she gets a private pension of $90. And so her total income is $464 a month. And so that is the reason that she gets no gains for the aged, because that's over $2,000 a year. But it's also going to reduce her guaranteed income supplement down from $917 down to $610.38. Why? Because the GIS clawed back 50% of her income between $364, her $10 from savings, and her private pension of $90. Put that all together, and her clawback takes her down to $610 in GIS that she receives because of the clawback. Now, she also gets refundable credits, like that's Trillium, carbon credit, GST credits of $96 a month, and her total average monthly income brings her to $1784 per month, and she has total yearly income of $21,414, and that would put Tina in a situation of being in poverty because she's below the poverty line, but she's in what's considered to be shallow poverty. In other words, she's just a little bit in poverty. She's not a lot in poverty the way somebody on Ontario Works or ODSP would be in poverty. Okay, so that's our test on Tina. So it gives you an example of what happens to people, even at fairly low income, who are below the poverty line. They still get their GIF clawed back, and they don't get any gains payment. So what we have now for the last couple of years, and it started in 2019, there's a new form for old age security. So all you 64-year-olds out there who are applying for old age security because you heard Paul McCartney's song, When I'm 64, and people were starting to sing it to you with a big smile on their faces, that meant that they were announcing to you that you were about to turn 65 in a year. So you want to get a hold of the old age security form, the application form, which in this case is one form now. The form for OAS is also the form for the GIS. It used to be separate. It is no longer separate. So when you're applying for the old age security, it has a section C that says applying for the guaranteed income supplement. And then it says, if you do not want to apply for the GIS, click this box. I'm telling you right here, don't tick the box. Leave the box to the ticks. Leave the box alone. Why do you leave the box alone? You leave it because if you're low income and you're going to be below those amounts that I showed you a couple of pages back, and even if you're unsure, just don't tick the box. They will decide if you're eligible for GIS. Now, why do a lot of people tick the box or get really nervous about it? It's because at the end, when they go to put their signature on this, it says you realize if you put on any wrong information, you can be charged under the Old Age Security Act and under the Canada Revenue Agency, and you can be charged and brought to justice because of it. But that does not apply to this box. This applies to people who are trying to hide money or apply under an assumed name or something like that, something that's really illegal. But for people ticking the GIS box, they will tell you whether you're eligible or not. So don't tick the GIS box. If you do, then you could be doing yourself out of up to $917 a month. Don't worry about the fact that you don't really know what your income is or whether you might be above or below by a little bit. They're not really concerned about that, and it's not the sort of thing that they're looking for when they say people could be convicted of some sort of crime. Because what a lot of people think of when they see that, they are thinking of the Crowbar Hotel. And what's the Crowbar Hotel? That's jail. So nobody's going to put you in jail. So for not ticking the box for GIS, just leave it alone. So there I am. It's a tick box on the OAS GIS form. If you're low income, don't tick the box. If you're unsure, don't tick the box. No need to worry. Don't tick the box. Fill it out, answer all the questions, and then finally file your taxes. Because the federal government will say they don't know how much income you have unless you file your taxes, which of course is not true. They do know how much income you have, but still we live in this, we're at a point in our evolution where we still have to file our taxes. But the federal government announced in the last throne speech, they said that they are going to move into auto-enrollment. Why? Because they already know the answers to most of the questions. And how do we know that they know the answers? Is because if you send in wrong information, they will correct you. How many people out there have put money into, filed their return, and then they get a note back from the CRA saying, you didn't get this quite right. Well, if they didn't have the information to begin with, they wouldn't be able to send you those letters. So sometimes they'll send you an extra refund and you're happy, and other times they'll be sending you a bill and you'll be unhappy. But they, generally speaking, already know, but you still have to file your taxes. So the application for the Guaranteed Income Supplement for postal codes beginning with L, M, or N is Service Canada, right here in Scarborough, from where I'm talking from. The building down at the Scarborough Town Center. So make sure that you send it to the right place. If you don't send it to the right place, and there's a whole bunch of addresses on the form, and some people neglect to look at it, and they'll send their application out to Alberta. Well, that means you'll just take extra time, and some people wait till they're 65 and a half before they get any old age security. So it's really important that you send it to Scarborough. If you're, most people in Toronto, their postal code begins with M. So if you're calling from Toronto, then you're sending it to Scarborough, and with L, or if it starts with L or N. So it's important that you send it to the right place. So just to review, what forms of income do not reduce your GIS? So we're really, really interested in keeping the most amount of GIS that we can possibly have. And so we need to know what sorts of income do not reduce your Guaranteed Income Supplement. Well, the first one, of course, is old age security itself. In fact, you're not eligible for GIS in the first place unless you're eligible for old age security. You can't get GIS without getting old age security, so they don't claw back old age security off your GIS. The second big thing is tax-free savings accounts. Money that you take out of a tax-free savings account is not, money that you take out of a tax-free savings account does not reduce your Guaranteed Income Supplement. but money that you take out of an RRSP does. So where do you want to have any savings that you have? You want to have it in a tax-free savings account. Thirdly is registered disability savings plans withdrawals. And then the fourth big one is any refundable credits you get with your income tax refund, whether it's child benefits, Trillium, working income tax benefits, which now is called the Canada Workers Benefit, GST credits, the new carbon credit. All of those do not count in the GIS clawback. So OAS, TFSAs, RDSP, and refundable credits don't affect your GIS. So when you save, you want to save in a tax-free savings account, not in an RRSP, because when you take the money out of a tax-free savings account, what happens to your GIS? Nothing. Take it out of an RRSP, it's 50 cents on the dollar at least. So RRSPs and TFSAs, are they the same? They're, in one important way, TFSAs and RRSPs are the same in that you can put the same things in them. You can put cash, bonds, stocks, exchange traded funds, guaranteed investment certificates. You can put into an RRSP, and you can also put the exact same thing into a TFSA. But then they differ, because an RRSP, you get a deduction when you put it in. With a TFSA, you don't get a deduction when you put it in. Income in a TFSA grows tax-free, same with an RRSP. At low interest rate, it hardly means anything, but the money grows, it's not taxable within the TFSA or the RRSP, but it's when you take the money out where things really get interesting. If you take money out of an RRSP, it is taxable and it reduces your GIS. When you take the tax-free savings account, take money out of it, it is not taxable and it does not reduce your RRSP. So if you're low income, the place to be is TFSA. So if you're 55 years old and you think you're going to be eligible for GIS at age 65, I'm telling you right now, get rid of your RRSPs, cash them out, and put the money that you get in from them to a TFSA. But you'll be taxed in the meantime, taking it out before 65, but you're better off in the long run to take the money out of an RRSP now if you know you're going to be eligible for the guaranteed income supplement. And any money that you have in there, put it in a TFSA, because when you take it out, it's not going to cause a clawback and it's not going to cause you to be taxed. So what does taxable income mean? So generally speaking, taxable income is the amount on line 260 of, or now 26,000 of your tax return is considered taxable income. And generally speaking, if you're below 65 and you have $16,000 in income or less, you're not going to pay any tax. And if you're a senior and your taxable income is 21,000 and less, you're basically not going to pay any tax. So in other words, you'll do your tax return out, you'll send it in, and you'll either get a small refund or you'll be even up, but you're not going to pay tax at those amounts. So moving on, how do we reduce taxable income or get money back, understanding the system? So what I'm going to do is I'm going to take you to the grocery store in your own mind, because the grocery store or the drugstore works exactly the same as the tax system. So what we have in the tax system are some elements that most people don't understand. We have elements like a non-refundable tax credit. We have refundable tax credits. We have exemptions, deductions, and entitlements. And most people read those terms and they glaze over and they say, what does all of that mean? But anyways, if you were to go into the drugstore and you were to say, and you were to see a whole wall full of coupons, well, I can tell you right now that a coupon is like a non-refundable tax credit. Now, if you're to take a coupon, let's say a $7 coupon for Tide, and you were to take it down from the wall inside a supermarket or inside a drugstore, and you were to take that coupon to the cashier and say, I got a $7 coupon here for Tide, give me my $7. The cashier is going to look at you and say, you don't get $7 for that. You have to buy Tide. You have to get. You can only get it if you buy Tide, and that's how a non-refundable tax credit works. Non-refundable tax credits only give you money off the taxes that you owe. Okay, they only give you money off the tax. So if you don't owe any tax, like you're on ODSP or receiving Ontario Works, or you're working poor, very low income, and you don't pay any tax, then those coupons are not worth anything to you. Just in the same way as a coupon, if you don't buy the thing that the coupon is for, then you don't get any money off, right? You have to buy the item, and it's the same thing. If you have taxes and you have taxes owing, then the non-refundable credits are like a coupon off your taxes. Now, refundable tax credits are like gift cards. And the refundable tax credits are credits that you get in actual money even when you don't pay any tax. So you might not owe any tax at all. A lot of people say, well, why file my return? Because if I file my return and I don't owe them anything, why would I bother? Well, because you're leaving money on the table. The carbon credit, the GST credits, the child benefits, the Canada Workers Benefit, those are all refundable tax credits. They are all government gift cards that you're leaving on the table if you don't file. And are they going to come after you because you didn't collect your gift cards? No. If they owe you money, they're not going to talk to you. If you owe them money, they will go after you. So it's refundable tax credits are like gift cards from the government, and even if you don't pay any tax at all, you still get money from the government. Now I'm just going to go one down to deductions. Deductions are a bit different because, if let's say I'm working and I make about $50,000 a year, I'm going to be paying some tax, and let's say I go into the drugstore and I got my $7 coupon for Tide, and I check out, and I'm checking out with the cashier, and I present my $7 coupon for Tide. How much money am I going to get off? Well, the answer is I'm going to get $7 off, because everybody gets $7 off. But let's say I'm the richest man in Canada, and I'm making huge salary, and the amount of income tax I pay is much higher. And but how much is the clerk going to give me if I go in and buy a tub of Tide? How much is the cashier going to give me off that? Well, they're going to give me the same $7, because it doesn't matter whether you're rich or poor. Then you get the same amount. You get the face amount off the good that you're buying. Well, that's how non-refundable tax credits work. Just like a coupon, rich or poor, you get the same amount off, right? But a deduction works differently, because a deduction is from your income and it depends on your tax rate. So if deductions work like non-refundable credits, then the cashier, when you presented them with your coupon, they'd have to say, well, how much money did you make last year? You say, what do you mean? Well, how much money did I make last year? Well, I don't know the value of the coupon unless I ask you what your tax rate is. You see, because the RRSP deduction, for example, you could have one person with a $10,000 deduction, a second person with a $10,000 deduction, and a third person with a $10,000 deduction. So somebody at the 50% tax rate, the $10,000 deduction is worth $5,000. For somebody at the 20% tax rate, the deduction is worth $2,000. And the person who pays no tax at all, the deduction is worthless, because it's money off your income. It's not money off your taxes. So a deduction is money off your income, and a non-refundable credit is money off your taxes. Whereas the refundable credit is like a gift card from government paid out as an income security payment. Tax exemptions are simply income amounts of money they don't want to know about. So if you sell somebody a neighbor and you sell them a couple of books or something like that, you don't have to report that on your income. And as you know, or if you have a garage sale, or if you win a bingo, these are all tax exempt. Even lottery winnings are exempt in Canada. And entitlements really are monies that you get from government that are outside of the tax system. So these are entitlements you get, whereas every income security payment that comes from government since 1978, every single one of them has been paid through the tax system. Everything that was paid through the COVID-19 package, every one of those was paid through the tax system. All the child benefits are paid through the tax system. All the Canada Workers benefit is paid through the tax system, the carbon credits and everything. Anything new since 1978 has been paid through the tax system. So we only have entitlements from programs that were before that, like social assistance, workers' comp, employment insurance, Canada Pension Plan. Those are all entitlement programs, but they all came before 1978 when they started using the tax system for everything. So let's review non-refundable credits. Non-refundable credits are like a tax coupon, redeemable for money off your taxes. And over the years, we've had all sorts of different government coupons, like the child fitness credit that's no longer there, the medical expense tax credit, which is there, the education tax credit, the transit pass tax credit, which has been changed, the charitable donations tax credit, the disability tax credit, spousal tax credit, caregiver tax credit. All those amounts are like coupons off your taxes, only work when you have taxes to pay. If you have no taxes to pay, those coupons that you have are worthless. And just in the same way as you take a coupon for Tide and you try to take it to the cashier without buying Tide, you're not going to get $7. You're only going to get it off if you buy the product. And in this case, you're only going to get money off your taxes payable. You're not going to get it doesn't work like a gift card. It's only money off your taxes paid. So there's a $7 coupon for Tide, just to show you that there is one. More non-refundable credits are all like coupons. And then refundable tax credits are like gift cards, as I said, GST, HST credits, the Trillium benefit, Ontario, working income tax credit, which they now call which is now called the Canada Workers benefit. All the child benefits of various supports of various types are all refundable credits that are paid by the government to people, regardless of whether they pay tax or not. Refundable tax credits, they're a gift card that you redeem for money. And tax exemption, it's just forget about it. No need to report it. Racetrack winnings, sale of your car, garage sale, reimbursed expenses. Now there's one I need to change, sale of a principal residence. Now you do have to report it, but they don't take any tax off it. So that was a change they made a couple of years ago. And then finally, deductions. Again, it's like a specialized coupon. It's different for everybody. For the rich, the deductions are worth more. For the poor, the deductions are worth less. For the very poor, the deductions are not worth anything at all. Okay, so and entitlements, it's like certificate of possession, documentary evidence of ownership and eligibility, like what I would call like an entitlement card. So Canada is an ownership society. We believe in property and owning property, and as long as if you own property, all you have to do is to keep it up to date. Now, the example I like to use is vehicle ownership. If I go out and I drive my car and I see, if I hear a siren and I see lights flashing and the officer is taking me over to the side of the road because I don't know what yet, and that officer is going to ask me for 4 things. They're going to ask me for my license. They are going to ask me for my vehicle, my ownership. They are going to ask me to prove insurance. I got to have to prove the insurance card. And then finally, I got to show that they're going to go to the back of the car and they're going to look at my license plate and making sure that the little sticker on there is not before today's date. because that's also an offense. So there's 4 offenses right there, right under the Provincial Offences Act. You don't have your driver's license, that's an offense. Don't have your insurance, that's an offense. Don't have your ownership, that's an offense. Don't have the right sticker on the back of the car, that's an offense. You can get 4 different tickets. I can personally vouch for having gotten all 4 of them for an illegal right-hand turn. So this is really important that that we know with car ownership, we know that we have to have those things in our car. Everybody knows it. You got a car, you own a car, you know you're going to have those things, and if you forget them, you know you can be in trouble. But you don't turn around and say, I own my car, and because I own my car, I shouldn't have to have documentary evidence. Well, the reason I use this example, because the same thing is true for any of the entitlements that we have. When we have the entitlements, like whether they're EI or old age security or any other things like Canada Education Savings Grants, CPP, assistive devices, disability grants, etc., that are all on here, these entitlements, you have to apply for them. You have to meet ongoing eligibility requirements. You have to file your tax return, and you have to show documentation and update their documentation. And you just see so many people who leave money on the table in terms of those refundable credits, those gift cards from government. Why? Because they just didn't keep up their information. So what they would not even think of doing with their car, you wouldn't think of, unless you forgot, you wouldn't think of driving your car without your insurance and your license and your ownership and your proof of payment on your license. You wouldn't think of doing that. Yet so many people just ignore that when it comes to their entitlements, and really their entitlements work the same way as so even though you own your entitlements, you're eligible, you're categorically eligible, you're financially eligible. It's just like owning a car. Just because you own your car doesn't mean they're going to let you drive it if you don't meet all the rules. So the tax refund, I've often asked people, well, what's in a tax refund? Now, of course, you get a refund if they owe you more than you owe them. I got that. And you owe the money at a special time of year, which keeps changing with COVID, that you owe them money if you owe them more than they owe you. So, but remember, let's go back into the drugstore or the grocery store again. And let's say you have a bunch of things that you're buying, and you have a whole bunch of coupons for them. And then you have some gift cards and that sort of thing. If the value of your gift cards and your coupons exceed the amount of your purchase, then that's like getting a refund. But if the amount of coupons and your gift cards don't meet the cost of the things that you're buying in the store, then that's like you owe money. And that's the exact same way to think of it in the government store, is that your refund is made up of non-refundable credits, deductions, and refundable credits. Put them all together, and if they are higher, if that amount exceeds what you owe, then the government is going to pay you a refund. But it's a combination of all of those things: your deductions, your non-refundable credits, and your refundable credits. People often think, oh, well, the reason I got a refund is because I just have these refundable credits. No, it's a combination of deductions, refundable credits, and non-refundable credits, just like it is when you take coupons and gift cards and money into a store. And it's really important to think of it this way, as the combination of things, because that's how it actually does work. So let's move on from here, and that is protecting a low retirement income. And the first question we're going to ask is, should everyone apply for old age security once they're turning 65? The answer is yes. The only people who would not apply are people who have been in Canada for less than the qualifying period. So for countries that don't have an agreement, that's 10 years. And for people who do have an agreement, their country has an agreement, they're in one of the 59 countries, then they should apply. and you apply 1 month after your 64th birthday. Don't wait till you're 65. Don't wait for 6 months before. Don't wait for 3 months before. 1 month after you turn 64. So if people are singing Paul McCartney's When I'm 64 to you and they think it's funny, you should be thinking, oh, I should be getting my old age security form. Now, a whole bunch of people are often think that the government is going to send them their old age security form. And for many, that's true. If you're on ODSP or if you're receiving Ontario Works, the government's going to make sure that you get those forms sent to you. Why? Because they want you to go off on your 65th birthday. So they're going to make sure that they get those forms to you. Secondly, if you're in a registered pension plan, the same thing is going to happen. If you're in a registered pension plan, they're going to make sure that you're going to get those forms before 65. Why? Because they want to pay you less pension once you turn 65. Most blended pensions, you're going to get a little bit more from the pension before 65 than you are after 65 because they blend it with old age security, okay? And they blend it with your CPP. So they're going to make sure you get it. But you might be one of those persons that say self-employed or you're not on any of those programs or you don't have a pension. Don't count on getting the form mailed to you. Go to Service Canada and get it, or go on the website, Service Canada site, and get the old age form there, or go to the old age program. Just Google it. And you'll get the old age form and you can fill it out. Make sure that you don't tick the box for GIS on the OAS form or they won't do it. They will tell you if you qualify for gains. And if you file your tax returns to make sure you get other credits and benefits, and GIS will be renewed automatically each July. Now this year, they gave us a holiday for sending in our income taxes, but if you don't get it in if you haven't filed your return by January, you could be suspended from your guaranteed income supplement, okay? So it's really, really important if you get it in. Anybody who read the Globe and Mail yesterday, I was interviewed in the business section and said the very same thing to a reporter by the name of Rob Carrick, saying it's really important to get your taxes in even during this time of COVID. Even if you only, fill it out partially, sign it, put your social insurance number on it, send it in, and that way they can take a look at it. But don't even fill it out the best you can. Do it online. You're much better off to do it online than do the old paper returns. The government is trying to move everything online. So if you can get help doing that, then that's all the better. But do get it in, because if you don't, you might not get your GIS. So should everyone apply for OAS? Yes. Now, do it as soon as you approach 65. Like I said, half are enrolled automatically and will receive a letter. Only apply if you don't receive the letter. But if you don't receive it by at least, a couple of months after you turn 64, don't sit and wait around. Go get it. Even if you've not been in Canada long, you may get some OAS. If you qualify for OAS and you have a low income, you will qualify for some GIS. So it's really important to get the application in there and to file your return. Should you work after 65? Well, isn't that a question? If you're low income. Well, what we see here on these graphs is that going back to the 70s and then looking through to about the year 2000, fewer and fewer people worked, whether they were 55 to 59, 60 to 64, 65 to 69, and 70 years and over. Fewer and fewer people worked. But once we got to the year 2000, we started to see more and more seniors working for a variety of different reasons. But one of the big ones in Ontario in 2006, mandatory retirement at 65 was abolished. So we start seeing more and more people working after age 65. We also see, when we look at women, for example, we could see that, starting around 2000, 2006, and in anticipation of there being no mandatory retirement, we see women working more and more going back into the labor force. But what if you're poor, and what if you're low income, and what if you got GIS and you got the GIS clawback? Well, I've run into, here again, just another couple of graphs showing you that more and more, look at 2020, we're seeing people, almost 50% of people, 60 to 64, the employment rates for men, for women, are very, very high. And even for people over 70, you're seeing more and more of them working. So if you're on GIS, I'm going to tell you either to work a little or work a lot. So we know that if you work up to $5,000 a year in net earnings, then there's going to be no GIS clawback. Okay? But once you get to $5,000 in earnings, which is around St. Patrick's Day at minimum wage, then you're going to get clawed back. You're going to get clawed back at 50 cents on the dollar at least, and then it goes up above that for some people. But if you just work, then it'll be 50%. And again, it's you really need to think about whether you're working or not. If you're receiving an honorarium, that's not working as far as the old age security is concerned. You only get the $5,000 exemption if you get a T4 slip from your employer. So I see a lot of people, men in Walmart greeters or in working in home hardware or places like that, who are obviously over 65. You see women, especially north of Toronto, working in Tim's or in fast food. They're not there because they don't need the money. They do need the money. But boy, if you're looking at clawbacks that are over 50 cents on the dollar and after $5,000, you really got to think about whether you should be working at that point. So that's why I call it the St. Patrick's Day rule, because minimum wage of $14 an hour, everything up to St. Patrick's Day is going to be exempt. And then after that, you're going to be not only paying tax and an EI, you don't have to pay into CPP once you turn 65. You can get a form that says, I don't want to pay into CPP at age 65 anymore, but you're paying into EI, you're paying taxes probably at source, and then you're getting the 50% at least at clawback off of the GIS. So think about working beyond St. Patrick's Day, and unless you're going to work a lot and really go over the GIS. Remember those numbers, like $18,000, $18,600 for a single GIS recipient. If you're going to work more than $5,000, then you might as well work a lot and get out of the clawback zone, not get any money from GIS, and then you won't be suffering this real clawback. So it's really between $5,000 and $18,000 where you're going to see the real effect of the clawbacks. And so you really need to think about how much you need the money. If you really do, then do it, but you're going to have these really onerous clawbacks on you at that point. Now I wanted to get into honorarium for a moment. You can see here, this is Philip's story. He was a near senior living on about $1,000 a month from ODSP, and he volunteered for something called the Dream Team, and then he turned 65. Philip and I were back in the papers back in 2015 because he received $1,490 in honoraria, but he had very, very low income. Philip had been homeless, he had mental health issues, and he didn't work very much beyond his 20s. And so he had less than $2,000 a year in income. He only had the $1,490 once he turned 65. And guess what? Gains clawed back 50 cents on the dollar, and GIS clawed back 50 cents on the dollar. And Philip ended up getting nothing. So, it's really, for people with really, really low income and they receive honorariums. Of course, if you're on ODSP and OW before age 65, that amount of income is exempt as gifts of small value that paid to you. There's a $10,000 exemption on OWs, $40,000 on ODSP. But once you become a senior, wham bam, and in Philip's case, he got $1,490 in honoraria, and he paid his transportation out of that. spoke to various people, and had it all clawed back on his income tax. So how do you stay out of that? Well, the T4A slip trigger point is $500. So you want to make sure, so any organization, even if they're paying you money out of the cash box, the trigger point is $500. So stop collecting honoraria at $499 from any one place. Then go volunteer somewhere else. Volunteer for another agency for your next $499. Or if it makes sense to you, reduce your taxable income by contributing to an RRSP, but that's I'm going to get into just a little later. And a bit ahead of the game here, so we're going to have some time for questions in a bit. But anyways, should you take early CPP? The answer is the usual age to take it is 65. Early CPP is age 60. It's a little less money, but you may need it now. If you're on social assistance, ODSP, OW, don't take it early because they'll claw it back. And after age 65, you won't have to worry. But early CPP at age 60 is something you should do if you know you're going to be eligible for the guaranteed income supplement. Then take your CPP early. Why? Because once you turn 65, the amount of CPP is less, which means the 50-cent clawback is less. 50 cents, 50% clawback of $1,100 is $550. 50% clawback on $700 is $350. So in other words, you're trying to reduce your clawback, have less money once you turn 65. You want to make sure that your clawback is lower, and that's a good way to do it. But again, if you're on social assistance, it doesn't work. So what if you really have low income, under $2,000 a year? This is just a small note here to social services agencies that get all low income people to retire or to apply for their CPP at 65. For people with really low income like Philip, they should be waiting until they're 70. Why? Because if they apply for their CPP at 65, and that's what happened to Philip, he applied for a small amount of CPP at 65, and Gains took 50 cents on the dollar and GIS took 50 cents on the dollar. So Philip should have waited till he was 70, but it's a small amount of people who have under 2,000 a year. So I'll just leave it at that. So the main thing I want to end here with is the parallel universe of low income retirement. Why? Because mainstream banks and institutions will always be telling the people, get your RSP, buy your RSP, get it early, and don't cash it in until you're 65. I'm telling you, don't buy an RSP at all, and if you did, cash it in before you're 65. So that's a real parallel universe, and they're saying, well, most people make more money before they turn 65, and then they make less money after 65, so that's why they should take an RSP, because the deduction will be worth more than the taxes later on. Well, is that true for low-income people? A lot of low-income people make less money before they're 65 and then make more money after they're 65. But even more than that, for low-income people, often the money they get before 65 is not taxable. OW is not taxable. ODSP is not taxable. Certain settlements are not taxable. Certain inheritances are not taxable. But you turn 65, OAS is taxable. CPP is taxable. RRSP cash outs are taxable. Pensions are taxable. Earnings are taxable. Honorariums are taxable. So you see that a lot of things after 65 are taxable, whereas a lot of things before 65 are not. And so that's why you're in a parallel universe. Do everything backwards, and you're probably going to do something that makes more sense. In other words, cash out of your RSP beforehand, and then put your money into a Tfsa, and that's the best way to do it. So, as I said, middle and high income people middle and high income people have less income after they stop working, but most low income people have more. Most middle and high income people pay less tax after they retire, but most low income people, of course, don't pay tax. But they might have to when they start getting CPP and OAS, because those forms of income are taxable. So should you buy RRSPs? Well, I think I've already given you the answer here, is only when your CPP, OAS, and other income means you might have to pay tax. But what you can do, and here's your parallel universe again. Remember I told you don't buy an RRSP before you're 65 and cash it out if you do. And the banks and the mainstream media will tell you that you should buy one before you're 65 and then cash it out after. I'm saying you shouldn't buy one before and cash it out before, but once you turn 65, then buy an RRSP, because you can buy RRSPs between age 65 and 71. And of course, there's a deduction with the RRSP that lowers your income, so it'll increase your GIS. So that is something that's really available to people who are in a position to lower their income, and they're already in the zone where they would be eligible for GIS. Let's say they're around 18,000, but they could put $10,000 a year into an RRSP between 65 and 71, then they're really going to turn on the GIS taps during that period of time, and they'd be much better off having that. Now, of course, they're going to have an RRSP when they turn 71 that's going to turn into a Rrif, but the taxes on it are very low for low-income people. So you're going to get way more money in GIS between 65 and 71 than past that time. So why do I tell people to cash out of RRSPs before 65, even though we know that they're going to have tax withholding on their RRSP withdrawals? They can 10% up to 5,000, 20% up to 15, and then 30% over 15%. But remember, that is a withholding tax, and it's refunded if you don't pay tax. But even if you do pay tax, it's still less. It's still less, right? Than the 50% and 75% reduction on GIS, plus tax that you will pay after age 65. So there's the amount of money that you're going to pay in tax paying by taking money out of an RRSP before 65 is much less than you're going to pay afterwards. Okay, so that's an important consideration. And so your notice of assessment is a gold mine, because at the bottom of your assessment, it gives you your RRSP deduction for the next year. Now, for a lot of low-income people, and I've given advice to a lot of low-income women especially, and they say, oh, there's nothing on my tax assessment that can help. And I say, yeah, we'll bring it in. Well, I saw some women, very low-income women, but had been worked most of their life. They'd never put money into an RRSP. And I was seeing, for example, at some people with them that worked at minimum wage type jobs all their life, but they would have over $150,000 in RRSP room. And so that's really a gold mine between their 65 and 71, because then they can start putting money into an RRSP, and then it's going to turn on the GIS taps because their income is lower. When their income is lower, you get more GIS. So for that 6-year period, you can do that and make a lot of money. And then, of course, as I said, you're going to have a Rrif after that, but the amount of money that you take out and the tax you pay on it is going to be so much less than the amount of GIS that you got between age 65 and 71. So let's just do a checklist here of taxable income before and after retire. Before age 65, you can see that Ontario Works, ODSP, pain and suffering awards, and some settlements are not taxable. But after age 65, earnings, CPP, old age security, RRSP cash outs, private pensions, investment income are all taxable. So it's important. So that's why you're living in the parallel universe. You're in where you pay less before and you're paying more after. And of course, if you take an RRSP out before you're age 65 and you don't have much earnings, then your deduction is worth a whole lot less. And that's another reason not to buy, if you're low income, not to buy into an RRSP in the first place. It's good for rich people who have 50% tax rates, so every $10,000 in deduction, they're going to get $5,000 in refund. But for somebody who hardly pays any tax, maybe they put in $10,000 into an RRSP and only get $500 back, So it could be 10 times as much for somebody as high income, and that's why RRSPs are really attractive to higher income people. So should you buy RRSPs? They make sense for higher income people, but it makes no sense for low income people until they start getting CPP and OAS. So wait till you're 65 to buy an RSP if you're low income. There's the deduction, line 208. There it is, a screenshot of the GIS, of the old GIS form. You have an RSP deduction that allows you to reduce your income and therefore get more GIS. So should you save in a TFSA? Tax-free savings accounts are always a good way for low-income people to save. The interest you earn can't be taxed. You don't have to take it out until you want to. Money in a TFSA can't be clawed back. But here's the real thing. Once you turn 71, and let's say you had put all your money into RSPs and they all turn, the RSP chariot turns into the Rrif pumpkin when you're 71, and then all of a sudden you need some quick money. Your car breaks down, your fridge doesn't work, or you have adult children that need money. Where are you going to take the money out of? You're going to take it out of your Rrif. And if you take the money out of your Rrif, the government is going to tax you at the very highest rate that you've probably ever been taxed at a time when you really need the money, say for an emergency. But if you had the money in a TFSA and you take it out, what happens? Nothing. You don't lose a cent. So there it is. Question, when you turn 71, what happens to a TFSA? Nothing. You take it out when you want, everything tax-free. And what happens to an RRSP? Your RRSP turns into a Rrif and you go into the Rrif bear hug, where you must take out an increasing percent per year, 3.96%. And by the time you're 95 years old, if you make it that long, then it's 15%. It reduces your GIS and all of it is taxable. So you don't want to be in a Rrif if you're low income. So mandatory Rrif withdrawals pre-COVID are on this page. Now let's look at them after COVID. You can see that they start at age 71, just under 4%. By the time you're up to 95, your Rrif, they're forcing you to take out 15% per year. TFSA, no forced withdrawal at all, ever, okay? So, can you leave Canada and collect? Our last question. You can collect any form of old age benefits for 6 months, but it's complicated after that. If you move elsewhere for more than 6 months, you need to have lived in Canada for 20 years between your 18th and 65th birthday. So here is all this 18th and 65th birthday coming back at us. And for old age security, you need 40 years in Canada to get full OAS. But if you've lived in Canada for 20 years between your 18th and 65th birthday, you can take your old age security and your CPP with you out of the country. For GIS, you must be in Canada to get GIS. And for some people, if Canada has an agreement with the country you're going to, and it depends on the country that you're going, there are 59 agreements and they're all different, but depending on where you're going, you can take your OAS and CPP out of the country. And there's a website there that you can click on when you get the presentation that will tell you what it is. So limited, where are the agreements? There's 59 agreements that we have. There's about 140 countries with no agreements. Limited agreements with no OAS advantage, unfortunately, with India and China. But their standard agreements, 1 year residency instead of 10 gets you OAS at 65. Recent agreements include Serbia, Brazil, Bulgaria, and Peru. So Canada is still signing those agreements. And they're reciprocal agreements. So it means that if we travel to those countries, we can get their version of old age security. And if they come here, they can get our version of old age security. So a lot of countries in the world won't give a Canadian moving to that country their version of old age security. So that's a lot of the reason why we don't have agreements with more than half the countries in the world. So 6 top tips. File your taxes unless you're in the Panama Papers and you have old debts. Make sure you file your taxes. If you have old debts, then you should talk to a lawyer or a tax accountant. Apply for early CPP if you're not on social assistance at age 60. Apply for old age security a year before you turn 65, in other words, age 64. Don't tick the box for GIS on the application form. Between ages 65 and 71, buy RSPs if you need them to reduce tax and need them to get more GIS and save in a tax-free savings account instead. So why didn't I get this money advice from the bank? Well, as I said earlier, banks don't make much money off people, so they don't invest in giving them good advice. And many people don't like income support. And the banks are uncomfortable trying to get people to maximize their guaranteed income supplement for some reason, even though they're entitled to it. But they often think of the GIS like social assistance, and so they won't do it. And how do we spread the word? Tell provincial and federal governments, to give better information, push the financial institutions. I'd love to see everybody at a bank, one person at a bank or credit union, understanding the stuff that I've just told you over the last couple of hours. Teach social agencies about the tax rules and income supports that affect low-income people. And that is it.